Good morning, everybody. Thank you very much for joining me for the last SERV member webinar for 2020. On this morning's agenda, we'll take a look at the October market and economic update. We'll then drill down into some of the single manager selection process that we use within the Signature portfolio range. I'll then remind you as a member of the Signia Umbrella Retirement Fund what your investment choice options are. And then finally, I'll conclude with the portfolio performance. My name is Tanisha Sabji, and I'm glad that you have given me the opportunity to chat to you this morning. Let's take a look at the market performance to the end of October, and starting with the 1 month number on the JSE SWIX, you'll see that very flattish returns with regards to our equity indices, negative 2.4%. Over 1 year, we're seeing a negative return of 7%. Just below that, we're looking at South African listed property, which has also struggled quite a bit over the month end, the year to date, as well as the 1 year number, a negative 51.6% return sitting within South African listed property. If we look at the JSE All Bond Composite Index, we saw a positive return of 1 year for 4.9%, and then one line below that, the STEFI Index having returned a 5.9% return. So within Signia portfolios, we have decided around 2 years ago not to invest directly into South African listed property. That was on the back of the resilient, stable group of companies that came under pressure, and we have maintained that asset allocation. So you can see that we've been able to protect our members from the negative returns sitting within that particular sector. As far as the JSE All Bond Composite Index goes and the STEFI Index, you can see that over 1 year, our defensive asset classes, which are cash and bonds, have done much better compared to the growth asset allocation being equities as measured by the JSE SWIX Index. Taking a look at our offshore exposure, starting with the MSCI World Index represented in South African rands. Over 1 year, we saw a return of 12.3%. And for the rest of the international counters that are reflected below that, you can see it appears as though we've got double-digit returns and that our international exposure has done much better compared to the local markets. Two reasons for this, one being that we've seen our currency, the rand, depreciate quite significantly against some of the developed world currencies such as the US dollar as well as the British pound. And then of course, in terms of Regulation 28 of the Pension Fund Act, we are allowed to take 30% of retirement fund savings to international markets. And as we stand today, we prefer to hold those international counters because what we are experiencing is that the international equity markets are in fact deriving better returns compared to our local market. If we step into the economic and market themes for November, starting with this gentleman, he is Dr. Anthony Stephen Fucci, and he spent a lot of 2020 trying to elaborate the importance of the coronavirus, trying to convince the previous president, Donald Trump, as well as the US population to take the global pandemic quite seriously. Unfortunately, just at this week, we saw that the number of US coronavirus cases have actually surpassed 12 million. So that's an increase of more than 1 million in less than a week. We are expecting additional lockdowns to be implemented, and from Monday next week, Toronto, which is Canada's biggest city, will go into a 28-day lockdown in order to try and mitigate the spread of the virus even further. As second waves continue to accelerate throughout the Northern Hemisphere, like the UK, Germany, and France, we are expecting that there will be a vaccine for the virus within the next few weeks. We've seen breakthroughs coming through from Pfizer, who has a 95% efficacy rate in trying to curb the spread of the coronavirus. However, the transportation and the storage of that particular vaccine was starting to see a little bit of difficulty. However, we are expecting that the Pfizer vaccine may in fact get Britain's regulatory approval later this week. Just behind that was Moderna, who's also now got a vaccine that is about 95% already in order to curb the spread of the virus. So that has given markets some optimism. And despite the additional risks to growth that we've seen within the most of this year over and above the COVID-19 pandemic, on the back of the US election results, increased fiscal stimulus that has come through as a response to that global pandemic, the Brexit vote being delayed to mid-November, we are expecting that markets will remain very close to record highs, which we've started to see coming through in the months of September, and also we anticipate for the next while. What's very important to note is that the second wave has not yet led to a significant increase in hospitalization usage or deaths, which implies that we don't expect further stringent lockdown measures to be imposed as far as economic activity goes. We've seen that markets have taken severe battering for a lot of 2020 because of the fact that some of the more stringent lockdown measures started to slow down economic activity. Taking a look at the US election, so Joe Biden is now the 46th president of the USA. He will be inaugurated into his presidency on the 20th of January next year. Just comparing the votes that he had won to Donald Trump, 270 electoral votes is the number that was required in order to win that US election, and Joe Biden had a comfortable win of 290 votes. We did see ex-President Donald Trump trying to contest those votes. He wanted the in-mail voting service to be ignored, and what we actually did find is that the Democrats favor the mail service voting over the Republicans. So now that the votes are clearly counted, we can see that Joe Biden has in fact won, and we do favor this Democratic win because we believe that going forward, Joe Biden would allow for more pragmatic approach to global trade policies, very different to what Donald Trump had put into place. He had a lot of chaotic policies. He started trade wars with China and other emerging markets, and we believe that going forward, Joe Biden will in fact start to put better global trade policies in place. October also saw the dollar moving to new lows. This is, of course, quite favorable to emerging markets such as South Africa because of the fact that we have almost 80% of our international debt denominated in the US dollar. So when the dollar starts to move slightly lower, that increases liquidity and it enables emerging markets such as South Africa to start to pay down some of that debt. Taking a look at China, their president continues to remain quite firm. The Chinese economy is doing phenomenally well. Despite the COVID-19 pandemic, they do have an annual growth target set of 5%. If you look at this particular graph, it's showing you the export volumes that have recovered so much faster when compared to the global financial crisis. One of the biggest reasons for this is because of the strong Asian export market within the electronic sector. So as a lot of the world starts getting used to the new normal, people are working from home, they are setting up work office spaces, perhaps purchasing a new laptop or an additional screen. And because of that, we're starting to see the export volumes within the Asian continent improve quite significantly. China also has the second largest economy, even though it is defined as an emerging market. What's very favorable for us as the South African economy is that when the Chinese economy grows, we then see our South African exports growing quite significantly as well. Remember, China makes use of almost 50% of South Africa's base metals. So the likes of iron ore, copper, palladium, they import it from our country, and South Africa definitely needs to kickstart our growth. So we will favor the additional exports to the Chinese economy. Please watch out for Signia's exchange traded fund launch of the MSCI emerging market, which we do expect to release within the next 2 months. If we take a look at the South African macroeconomic environment, it's been very difficult. A lot of South Africans waited bated breath during the month of October to see what the outcome of the medium-term budget speech would be. Unfortunately, we saw our finance minister, Tito Mboweni, imploring all South Africans to have faith. This is not necessarily the detail that we required in terms of that medium-term budget policy statement, and because of that, we saw the ratings agencies, S&P, Fitch, and Moody's downgrade us even further as far as our credit rating went. S&P was the only rating agency to keep the South African outlook on stable, whereas the rest decided to move us even further down into junk status. As you can see on this particular graph, the South African debt to GDP ratio will continue to surge. We expect the gross debt likely to peak close to 95.3% of GDP by 2025, and that is a massive increase from the initial 87.4% that we initially expected. South Africa is in the 13th year of load shedding. State-owned entities such as South African Airways continue to receive bailouts. We saw that after the medium-term budget policy statement was delivered, SAA got an additional 10.5 billion rand bailout, and this is not the end of it. We do expect further bailouts to be required by the state-owned entity in order to survive. Unfortunately for the South African investor, our economic reconstruction and recovery plan did not have the detail that is required, and we believe that going forward, foreign investors will definitely struggle to believe that South Africa has our growth trajectory in the right direction. We'll now take a look at the investment allocations, and this assists us in order to direct the portfolio allocations. Currently, we are underweight the South African rand. We do use hedge fund protection, and we are also underweight South African equity. However, we do not believe that South Africa is a failed state just yet. If you look at these two graphs, it's indicative of the fact that the South African rand still moves in line with that of other emerging market currencies. The rand is the most liquid, hence the most volatile emerging market currency, then that's because South Africa is a small open economy. We are very dependent on commodity prices and global trade. The good news is that we have seen a trade surplus for the past 5 months in a row, and this is on the back of China buying nearly half of our South African exports. So like I mentioned earlier, we do continue to favor the Chinese market improving quite significantly post the COVID-19 pandemic. If you then look at the bottom graph, that represents the equity. Our all share moves in line once again with other emerging markets, the latest divergence being driven by China's resilience to the COVID-19 pandemic. We do believe that some value has opened up quite significantly. At this point in time, South African equities are the lowest price we've seen in the past 100 years. So we don't believe that it's now time to sell out of the South African market, because we will expect to see a market cycle turn, and then ideally we will ride that particular divergence to add to the portfolio performance. If you were to consider why some of the South African shares did not do as phenomenally well as some of the US counters, tech would be the answer for that. We refer to the 6-pack of stocks, which is currently Facebook, Apple, Amazon, Microsoft, Alphabet, and Tesla. They currently make up 50% of the NASDAQ. So if you owned those 6 shares, you were in the money. Unfortunately, if you did not hold those specific technology shares, it felt as though you lost out on some of the best days in the market. What we have found is that the last decade has been predominantly denominated by those 6 tech stocks, as well as a strong US dollar. Going forward, we do believe that the US dollar will continue to remain low because of the Joe Biden presidency, and that the trade wars and the COVID-19 pandemic will start to revert some of those trends that we've seen over the past year. Structurally, we still continue to be bullish on tech stocks. We do believe that the share prices will continue to rise. What we have done is to move underweight those specific 6 super 6-pack of stocks, and we've moved into our 4th Industrial Revolution Fund. This is based on the headwinds we expected and anticipated quite correctly because of the antitrust issues that Donald Trump created with some of the Chinese tech market, and that on the back of the China-USA cold tech war. Privacy issues were a concern, and then the tax brackets. So now going forward, Joe Biden is likely to look at the tax thresholds for Apple, Facebook, Amazon, and the like, and he is likely to increase those particular brackets because in the past they were taxed quite low compared to other companies such as Seattle and Disney. We were also slightly concerned around the valuation because we did see that the S&P priced in almost 3 times the earnings growth of SA into perpetuity. One of the other key macroeconomic themes that we are focused on is the dollar and emerging markets. I have mentioned that the last decade was denominated by a strong US dollar. If we look at this particular diagram, it's research done by the International Monetary Fund, and it's indicating that by the year 2022, a lot of the Asian countries will actually eclipse the economies of the USA as well as the UK. So China will actually outgrow the economy of the USA, and India, Japan, and Indonesia will also be in the top 5 position. Because of that, we have started to move into these favorable emerging markets by taking our US allocation underweight and moving into some of the more favorable Asian countries. We do believe that Joe Biden, and as well as a low oil price, will continue to favor the weaker US dollar. That's why it makes sense to diversify away from that particular currency along with our international allocations. Let's now take a look at some of the single manager selections that we make use of. Let me remind you of the default investment strategy that you as a member of the Signia Umbrella Retirement Fund has available to you. So if your management committee has made a selection, they would have chosen between the skeleton range, the signature range, or the synergy range. The skeleton range is our passive only mandate, whereas the signature range blends active and passive management compared to the synergy range, which is a purely active balance mandate. According to the default life stage model, we start to reduce the risk over 6 years before a member starts to reach retirement. So well before 6 years of reaching your retirement age, you will be fully invested in a default life stage, either the signature, the synergy, or the skeleton 70 portfolio. And as you start getting closer to retirement, we then automatically de-risk you based on your age until 1 year of retiring from the fund, where you will be fully invested in either the skeleton, signature, or synergy 40 portfolio. If you as a member choose not to default into that strategy, you then have a choice of the 18 managers you see on screen, and we've separated them according to the risk continuum. So you will see high risk portfolios representative of the 70 ranges. We've got the single managers that are Allen Gray, Coronation, 91, and Fort, also as a growth type allocation. Within the medium risk, we've got the signature, skeleton, and synergy 60 range portfolios, and then the low risk portfolios encompass the 40 range portfolios. The money market portfolio is also an option for those members that have perhaps very close to retiring and they need to decide where to take their money once they've left the Signia Umbrella Retirement Fund. So taking a look at the strategic asset allocation, you'll see that within the signature, skeleton, and synergy 40 all the way through to the 70 range, we've built a strategy in order to invest within equities, bonds, income, as well as the international exposure. This is compliant with Regulation 28 of the Pension Funds Act, and we must pay attention to that particular offshore allocation in order to remain compliant. For the signature and the skeleton range, Signia is responsible for the asset allocation. We make use of tactical asset allocation as a risk mitigation tool, and we manage that almost on a daily basis. Within the synergy range, which is the active balanced option on the default life stage, those individual managers they represent their own investment philosophies when they choose the allocation to the local equity market. Across all of these ranges, the international portfolio remains the same. It is managed by Signia, and we make use of passively indexed tracking funds. So let's take a look at the skeleton manager selection. You'll see for equity as well as bonds, inflation-linked bonds, income, money market, and offshore. These are all of the different passive indices that we track. Within equity, we make use of the SWIX. Within bonds, we make use of our in-house passive bond fund. And then for income, we blend Signia portfolios along with Taquanta and Ashburton. Within money market, we make use of 91. 91 is the new name for Investec Asset Manager. They've recently gone through a rebranding exercise. Then taking a look at the signature manager lineup, you'll see that this is where the blend of active and passive management comes into play. Within the domestic asset allocation for equity, we make use of ABAX, 91, and Coronation. Those are the single managers that we need to decide on based on their various investment philosophies and style. Ideally, we never want to put two of the same managers in a portfolio that have the same function. And that's why we need to pay attention to the various investment philosophies and styles of the single managers in order to place them within the portfolio. I have mentioned that the international managers are the same across skeleton as well as signature. What we do there is replicate the indices that you see on screen. So let's talk about the different investment styles and factors that you do have an option of when you are considering single managers. Value and low size are one of the styles that focus on relatively inexpensive stocks. We also have momentum as a style, which focuses on purchasing stocks that are rising. In the opposite direction could be momentum of lower stocks that values are dropping. We also pay attention to quality type stocks, and there we look at sound balance sheet, or we could look for the percentage yield, and that would be indicative of the cash flow payout. So based on these various investment styles and factors that are available in the South African manager universe, we then need to decide which of these blends we want to use in order to make the most out of our particular portfolio. Some of the biggest themes we pay attention to are growth and value. Growth investors are attracted to companies that are expected to grow faster, either by revenue or cash flows, definitely by profits. As the growth is priority, these companies continue to reinvest earnings in themselves in order to expand. On the other side of the continuum is a value investor. Here we focus on finding the diamonds in the rough. These particular companies have stock prices that don't necessarily respect their fundamental worth, but we do expect these particular value investors to seek businesses that are trading at a share price that is currently considered a bargain. Later on in the market, we believe that that particular style will recognize the company's value and the price will then rise. Growth stocks are considered stocks that have the potential to outperform the overall market over time because of their future potential, whereas value stocks are classified as stocks that are currently trading below their fair value. Some of our managers blend growth and value, and we refer to them as growth at a reasonable price. They focus on growth companies, but they still continue to maintain an awareness of the traditional value indicators. Within the signature range, the managers that we make use of are ABAX, being the first one on the lineup. This particular manager focuses on a valuation-based security selection process. If you look at their sector allocations, which is depicted by the circle on screen, you can see that their highest allocation is to basic materials, 25% there. And then they do also invest quite heavily in the financial services sector, so the likes of banks and insurance companies. Their third highest allocation is to cyclical consumer type stocks. And then they've also got some allocation to the defensive type consumer selections. They've also got 2.4% within healthcare, which is ideally where you want to be placed because of the COVID-19 pandemic. And then you'll see technology at 23.7% within their sector allocations, also talking to the philosophy that they believe that they are in fact bullish on the tech sector. Looking at their top 10 holdings, Naspers, British American Tobacco, and Anglo American take the top 3 positions, with Prosus being in the 4th place. You will recall that that is actually the spin-off of the Naspers company. Then taking a look at 91, that is the rebranding of Investec Asset Management. They are currently focused on a profit and earnings expectations. So they look at stock-specific ideas where earnings expectations are rising and the valuations are reasonable. They've got a very high conviction portfolio and a solid term track record within the equity fund. This is the mandate we use within the signature range. Looking at their sector allocation, you'll see larger allocation towards technology at 26.4%, and then basic materials just behind that at 25.2%, a smaller allocation to financials compared to ABAX, and then of course healthcare also coming through at 4.1%. Their top 10 holdings also features Naspers, Prosus, Anglo American, and then you'll see some of the resource sectors, as well as the banks, First Rand, Impala, BHP Billiton, and Standard Bank. Next up is Coronation House View Equity, and this is also a valuation-driven investment house. They aim to identify mispriced assets that are trading at discounts to their long-term underlying value. They focus on through the cycle normalized earnings or free cash flows. Taking a look at their sector exposure, you'll see the highest allocation being to consumer services at 33.5%, and then financials at 24.7%, thereafter basic materials at 23.5%. They've got no exposure to derivatives, a very small exposure to technology, only sitting at 2%. And then once again, their top 10 holdings, Naspers, Anglo, First Rand, British American Tobacco. So where it may seem that a lot of these managers have the same top 10 holdings, each of the investment styles and philosophies are very different. The reason why their top 10 holdings appear similar is because the South African investment universe is quite small. However, each of these managers do focus on different investment philosophies and styles. And like I mentioned, we don't ever want to put 2 of the same managers in a portfolio that are doing exactly the same thing. So we've now covered the specialist approach, where a specialist manager is responsible for investing within the domestic equity market, and that is the investment philosophy we use within the skeleton range as well as the signature range. The next default life stage option is the synergy range, and what's different within this particular investment philosophy is that it makes use of an active balanced mandate. So as you can see on the left-hand side of the screen, that the managers that are used in this portfolio have discretion to invest across various different asset allocations. So they can use equities, bonds, cash, property, and offshore, not offshore, according to their discretion. The offshore mandate is managed by Signia with our passively managed indices. So on the domestic front, the first manager, being Alan Gray, can choose how to split their portfolio between equities, bonds, cash, and property. Very different to the specialist approach, which we saw within Skeleton and Signature, where we use a specialist equity manager versus a specialist bond or cash manager. So within the specialist approach, if you are appointed to manage equities, that is the only allocation you are responsible for. You do not also then have any discretion over bonds or cash. This slide indicates the managers that we use within the Synergy range, and you'll see Allan Gray, Coronation, 91, and Prudential featured. These are the domestic managers that have almost 70% allocation on the local markets to invest at their discretion. As far as the international managers go, we make use of the Signia International Balanced Portfolios, which are exactly the same as the Skeleton and the Signature range. The Synergy range also makes use of the default de-risking life stage. So when members are younger, well before 6 years of reaching their retirement age, you could be fully invested in the 70 range. And as you get closer to your retirement age, you then get de-risked into the Synergy 40 portfolio. And you can see that the Allan Gray balanced managers fully invest within Synergy 70. As we get closer to Synergy 50, and Synergy 40, we remove the Allan Gray balance mandate and we start introducing the Allan Gray stable mandate, thus talking to the risk appetite of managers, of members on the fund. So as the members get older, they focus on capital preservation. They don't necessarily want allocations to volatile type funds such as that provided by the balanced portfolio. A lot of research has been concluded that indicates that asset allocation is one of the biggest drivers of returns, much better than stock selection and manager selection. So if you look at this particular diagram, you'll see that asset allocation can actually contribute as much as 91.5% of the return towards a portfolio. So it doesn't matter that you sit in a room and discuss the performance of manager 1 over manager 2. Ideally, it's the asset allocation of a portfolio that will be the largest contributor to your investment performance. We do believe that the risk return trade-off is also at the core of what asset allocation is all about, and that's why within the Signature and Skeleton range portfolios, we pay a lot of attention to the asset allocation by making use of the tactical asset allocation overlay. So let's take a look at the 70 range portfolios to the end of October, and you'll see the differences within Synergy 70, where the domestic managers have either been higher or lower compared to the Signia portfolios across their asset allocation. Starting with South African equity, the Synergy 70 managers actually have a higher allocation to the local equity market, as well as a higher allocation to the local money market and international cash portfolios compared to our Signature 70 and Skeleton 70 portfolio. Also, the Synergy managers have a lower allocation to international equity compared to our positioning within Signature 70 and Skeleton 70. So now trying to understand how this has led to the individual performance on the fund, we will see within the next slide that asset allocation is quite imperative. From a performance perspective, the Synergy range has lagged the Skeleton and the Signature 70 fund, and that is mainly because of the asset allocation differences you see on the screen. So if I remind you of one of the first slides where we looked at the market performance, we saw the JSE representative of the local equity market having delivered a negative 7% return to the month end October, and that implies that the higher allocation you have to South African equities, the more likely your returns are to be lower. We've also seen that the South African Reserve Bank has slashed interest rates 5 times this year in response to a fiscal measure to try and curb the spread of COVID-19 and to stimulate the local economy. What the Signia portfolios have done is to actually gone underweight income and to rather rotate into bonds, whereas some of the single managers within the Synergy range continue to hold a higher allocation to the money market portfolio. Within the South African equity space, we do not hold any allocation to direct listed property, whereas some of the single managers actually do invest within local property. And then on the international equity exposure, we have maximized our exposure within Signature and Skeleton 70 because we believe that you are benefiting from the weaker rand, as well as the returns of holding the individual index or the stock, whereas some of the local managers are underweight international equity compared to our particular portfolios. This then translates into market performance to the end of 1 year, and you'll see that Signature 70 delivered 1.8% and Skeleton 70 delivered 2.3% compared to Synergy 70 at that point in time having delivered a 0.2% return. Some of the single managers that we offer to the members include the Islamic Balanced Portfolio, Allan Gray, Coronation, Fort, and 91. We've seen Allan Gray deliver negative 2.5%, which is in line with the global large manager watch median at that point in time. But as a member, I'm sure you are quite comfortable when you see negative returns coming through on your portfolio. Fort has delivered a comfortable 2.5% return over 1 year, and then Coronation Global Houseview has delivered a 1.2% return. Remember that at that point in time, equity markets had delivered that negative 7%. So this is where we're starting to see asset allocation translate into positive performance depending on where it is you chose to invest your particular assets. The money market fund over 1 year delivered 7% ahead of STEFI index at 5.9%. But of course, we are saving towards retirement funding, so we want to focus on the longer term track record. If we look at the 3-year and the 5-year number across the Signature, Skeleton, and Synergy ranges, you'll see positive returns coming through, all ahead of the global large manager watch median. Over 5 years, Signature 70 delivered 4.5%, Skeleton 70 delivered 4.6%, and the Synergy 70 fund then having delivered 5.2%, all ahead of that global large manager watch median of 3.6%. Thank you very much for your time. I appreciate that you've attended. Let me stop the presentation now to take a look at some of the questions that have come through. So it doesn't appear as though there's any questions that have been sent through right away, but I thank you for your time and we wish you well towards the year end. If there are any questions that come through over the next while, we will respond to them via email. Thank you for attending today's webinar and all the best for the festive season. Goodbye.